All right, and with that, I will call this February 25th, 2021 meeting of the Sac Metro Finance and Audit Committee to order. And so first item of, and let me just read this, public opportunity to discuss matters of public interest within the committee's scope, including items on or not on the agenda. Do we have any speakers?
We do not have any speakers who reached out beforehand, but Art, if you could unmute everyone and give them a chance to speak if they so wish.
Yes, attendees, you have the ability to unmute yourselves if there's anything you would like to present at this time. Looks like no response.
Very well. Then let's move into the action summary of minutes. We recommend the approval of the summary of the minutes for meetings of January 28th, 2021. Do I have a motion?
Mr. Chair, I so move.
I'll second.
I have a motion and a second. Will the clerk please call the roll?
Yes, and just to clarify, that is going to be for the entire consent. So we had 3 items on there.
Yes.
Okay. Director Jones,
Aye.
Director Wood,
Aye.
and Director Azali.
Aye.
Motion passes.
Moving to item 2, the quarterly investment report for December of 2020. And then that's also on the consent agenda. And the third item being calendar year 2021 investment policy. Do I understand that we just passed all of those?
Yes, all 3.
That's fine. Thank you. Moving then to presentation items. Finance report through December 31st, 2020. CFO Thomas, you're up.
Good evening. Hopefully you are all seeing my screen. Let me know if not. Great, thank you. So the first presentation this evening is for the financial report for the 6 months ended December 31st, 2020. So the first 6 months of our current fiscal year, 2020-21. So starting off, this chart is showing our medic cost recovery revenues for the fiscal year. And if you'll recall from the previous 2 presentations, really the trend that we're seeing this year, which is essentially unchanged for the most recent 2 months, is that the red line, which is representing our actual revenues for the year, is trending below the blue line, which is representing our budget for the year. So you can see on this chart, we have in our final budget a total of $43 million for the fiscal year. Our actual amount collected through the end of December was just under $20 million. So we have, as I mentioned, continued to see this revenue source trending below budget. I will let you know, not reflected on this chart, but that in January we did see some improvement. However, still overall trending below budget. This chart is showing us our total revenues for the year. So again, the red line is representing actual revenues for the year. The blue line is representing our budget. And you can see actuals through December were about 110 million out of a budget of about 239 million. What we can see is that we are, again, trending below budget overall, really attributable to those medic cost recovery revenues. But you see that in December, we had sort of a steep incline in the line there, and that's the result of receiving our first installment of property tax revenues. And you can see with the receipt of the property tax revenues, we really are, in terms of total revenues, closing a lot of the gap between actual and budget, but still overall have a slight difference between the actual and the budget number. This chart starts looking at the expense side of things. So this is showing us our salaries and benefits expenses. The red line representing actual expenses through December. And you can see that that red line compared to the budget blue line. Again, this is a trend that, that we've been talking about in the last couple of reports. You can see the red line trending above the blue line. So our actual expenses so far through December, about 101 million compared to a total budget of just under 195 million. And really what is contributing to our actuals exceeding our budget is higher than budgeted spending on overtime costs. I know we talked about this in the last couple of reports. I'll talk about it a little bit more when we get to the budget presentation. One of the factors contributing to that certainly is our overtime caused by workers' compensation as a result of COVID exposures. So we've definitely seen an impact of that through the first half of the year and are expecting that impact to lessen during the second half of the year as more vaccinations have been given, and overall we expect that to result in less exposures, lower workers' comp time, and then lower overtime. This chart is looking at total expenditures. So you can see by looking at the red line of actual compared to the blue line of budget, that despite the fact that our salaries and benefits expenditures are trending above budget for the first half of the year, our total expenditures are actually very slightly below budget. So actual of 123 million compared to a total budget of 237 million. And then this chart is showing our general fund reserves. So the green line is representing the current fiscal year 2020-21. And you can see again, with that first installment of property tax revenues, that green line has taken a turn upwards. So we're now in positive territory in terms of our general fund. So as of December 31st, the reserve balance was just over 30 million, which represented about 13% of our net budgeted expenditures. Based on our final budget, we would expect to end the year with a reserve balance of about 35.5 million, which would be 15.3%. And that's represented by the yellow dashed line on this chart. Looking at cash balance. So this is actual cash on hand in all of the district held funds, so not just the general fund. The green line is representing the current fiscal year. You can see that the balance as of December 31st was just under 42 million. You'll notice that this is, a large increase over where we were a year ago at the end of December. And really the reason for that is because of the timing of our property tax revenues. So in the previous fiscal year, while we recognized the revenues in December because that's when they were earned, we didn't actually receive the cash until January. So that's when you saw the cash balance line go up, that red line for last fiscal year. Whereas in this year, the cash was actually received in December. So that's what's accounting for the difference between the 2 years. And while we're now in positive territory in December, last year in December, we were still in a negative cash position, which we sometimes refer to as dry period funding, where we're essentially borrowing money from the county in anticipation of receipt of our property tax revenues. The last chart that we look at is our CERP or OPEB trust fund balance. So as of December 31st, we had about $61 million, which was made up of contributions of just under 43 million and interest earnings of over 18 million. As you know, this trust can only be used to pay retiree medical premiums. So it's held outside of the district funds and isn't included in the cash balance chart that I showed you earlier. So in summary, for the first 6 months of the fiscal year, Our revenues continue to trend below budget due to medic cost recovery activity trending below budget. Our expenditures overall are actually trending slightly below budget despite salaries and benefits trending over budget due to higher than budgeted overtime expenditures. Our cash balance is higher than the previous fiscal year due to the earlier receipt of property tax revenues. And then our reserve balance as of the end of December was about $30 million or 13%. And that compares to what the final budget projects as of the end of the fiscal year, which is 35 million or 15%. And that concludes this presentation. I'm happy to take any questions you might have.
I have a question for you, Amanda.
Yes.
In the previous slide, we were talking about the reserve levels at 15.3 million. And in this one, we're talking about reserve balance of $30 million or 13%. I missed something in there.
Sure. So I think what I probably wasn't clear about was the timing. So the December 31st number is 30 million, right? So that usually we're talking about the end of the fiscal year. So as of December 31st, it was 30 million, and I'll go back to the chart. Oops, let's see. Show you what I mean here. So right here is the line that I was referring to. So it's kind of snapshot sort of where we were as of the end of December. You can see, by looking at the prior fiscal year, this is sort of our mid-year, kind of high water mark, because we've just received the first installment of property tax revenues. We'll spend that down until we get the second installment. And normally what we're talking about is where we expect to end the fiscal year. And so that's what's shown here, but it's based on the final budget number and not the mid-year numbers that I will be talking to you about next.
Okay, so thank you.
Sure.
Mr. Chair,
Yes.
I have a quick question for Ms. Thomas. On
Please.
the CERT fund, I saw the assets of combined around 61 million. What's the outstanding liability that goes against?
So thank you. To kind of put this in context, I believe our net OPEB liability, which is liability minus assets, and our most recent audited financial statements was around 200 million. So
Thank you very much.
So we're making progress, but a ways to go.
That's good. I remember not too long ago, I remember 264 million, I think was the number that was in these reports. So that's good to see.
And if there are no other questions on this presentation, I can move on to start sharing the next one.
Yes, please do.
Okay. Just give me one moment. Is everyone able to see the presentation?
Yes.
Perfect, thank you. Okay, so sort of moving on, kind of moving forward through the year. We were just talking about the first 6 months of the fiscal year, and now what we're going to talk about is our recommended mid-year budget adjustments. So how we would propose revising the budget for the remainder of the year based on what we've experienced so far in the first half of the year. And as you know, this budget is presented to the Finance and Audit Committee in advance of presentation to the Board of Directors, and we anticipate that happening on March 11th. So just to start off with a bit of an overview, as I mentioned, our mid-year budget adjustments are based on the second quarter budget review. So we have our actual results through December 31st, which we just went over at a high level. And then we're making projections for the remainder of the year based on what we know now, which is certainly more than we knew when the final budget was adopted in September. At a very high level, the changes that we're recommending reduce the overall general fund budget surplus from $2 million in the final budget to a little under $1 million in what we're proposing for the mid-year budget. The largest factors in terms of the adjustments to the budget are the increased overtime expenditures and decreased medic revenues that we just talked about. There are some other changes that we are recognizing and proposing that help to offset some of those impacts, but those remain the largest factors. And then I think it's important to note that that remaining general fund surplus of a little under $1 million, the majority that really results from funding that was received this year for the Mobile Integrated Health Program, which has really been put on hold because of COVID-19 and some of the response that we're providing to that. So that funding that was received this year is essentially going to be dedicated to future year expenditures for this Mobile Integrated Health Program. The rest of my presentation is really going to focus on the general fund, but I do want to just mention that we are recommending some changes for transfers between some of the other funds, which essentially result in transferring excess amounts that have accumulated in the grants fund and the pension obligation fund to the capital facilities fund in order to help enhance our capital replacement reserve. So turning to look at the proposed mid-year budget for the general fund, you can see here on this table, we're showing the final budget in the first column, and then the mid-year budget in the second, and the variance between the two in the third column. Looking at total revenues, we're looking at a $1.3 million overall reduction in revenues, and I'll talk about some of the factors involved in that. For labor costs, we have $1.5 million overall increase in labor costs. You can see, however, we've identified some savings in services and supplies of about $1.2 million. And we do have a little bit of an increase in our assessments of $400,000. So overall, our total expenditures we're looking at an increase of about $650,000. If you look down to the transfers in and the transfers out, you can see that there's an increase in transfers in, which of a little under $200,000, which is resulting from some interest earnings that have accumulated in the IGT fund that we're able to transfer to the general fund. And then there's a decrease in the transfers out of the general fund of a little under $500,000, which is resulting from reduced debt service needs in the capital facilities fund due to the timing of financing for our assets that are being acquired in the current fiscal year. So looking at the bottom line, you can see in the first column, that's where we have our final budget surplus that was budgeted of about $2.2 million. The mid-year adjustments are resulting in about a $900,000 surplus. Looking a little bit closer at revenues, as I mentioned, total general fund revenue is decreasing by 1.3 million. The largest factors contributing to that are our deployment revenue. We have about a $2 million reduction there, just due to reduced deployment activity. So this is partially offset by a $1.7 million reduction in labor expense. Medic cost recovery, we're looking at a $1.9 million reduction, and that's really based on looking at our results, actually in this case through January, and projecting out the rest of the year based on historical trends. So we think about a $1.9 million reduction compared to budget there. We do have some increases that help to offset those decreases. So contract services revenue, we're budgeting for about a $900,000 increase. The majority of that is coming from a contract that is in place with the county to fund the COVID units that are operating now. So I mentioned earlier that that mobile integrated health program was on hold, and that's really because those resources have been redirected to this program, which is providing COVID testing, and we are getting reimbursed for that service under a contract that we have with the county. I will also mention that, that the resources that are providing this service are also contributing to our higher overtime costs. So this is one funding source for some of those higher overtime costs. And then finally, our property tax revenues we're projecting an increase of about $800,000 compared to budget, and that's really based on some of the property tax sources that we received payment for in December and January that are not tied to the current tax rolls, but are either supplemental or prior year amounts where we can project those revenues with some degree of certainty based on the amounts that have actually been received. Turning to look at our labor costs, as I mentioned, overall, we're looking at about $1.5 million increase in our labor budget. The largest factor here, as has been discussed, is our callback overtime. So overall, that's a $4.6 million net increase, and that's sort of after adjusting for the impact of deployments and vacancy savings, and we have some costs that sort of transfer from the shift overtime account. So this is really a net increase number. Again, as discussed, I'm sorry, was there a question?
No.
So, okay, so as discussed, the one of the primary factors contributing to this is COVID-related workers' comp vacancies and backfill. However, we're also seeing increases in other leave usage, so sick leave and vacation leave, compared to what had been budgeted. And also, as mentioned, we do have increases resulting from the service provided under contract at the county to operate the COVID units. So it's really a combination of factors. I will say that what we had seen in terms of workers' comp related leave and backfill for the first 6 months of the year, as I mentioned, we are expecting that to improve in the second half of the year. So that's really built into this forecast, is the expectation that that will improve. In addition to the callback overtime, as I mentioned, we do have a reduction in terms of deployment activities. So that $1.7 million reduction offsets the $4.6 million increase, as does an additional savings related to position vacancies of about $1.6 million. Looking at some of the other general fund impacts, we have a decrease in our services and supplies of $1.2 million for a total there of 30 million. And that's really the result of a couple of things. Firstly, there are some things that were budgeted at the beginning of the year in terms of either travel or training activities that because of the restrictions that continue to be in place are not going to take place this year. So we can remove those amounts from the budget. But additionally, I mean, I do really want to recognize the hard work of folks in all of the divisions and kind of scrubbing through the budget and looking at, you know, some of our year-to-date spending and identifying areas where we can have additional savings because this really has helped us to be able to offset the increases that we've seen in the labor budget so that overall our expenditures are much closer to our final budget amount and are helping us achieve a balanced budget at the end of the day. As I mentioned, we do have an increase in the taxes, licenses, debt service, and others line of about $400,000, and this is related to the GEMT quality assurance fee, which is imposed by the state. There was an increase in that fee amount that wasn't known at the time that the final budget was developed. So that's what's being reflected here. And then finally, the transfer activity, we do have a net additional amount of about $600,000 in general fund resources, which is resulting from an increase in transfers in from the IGT fund and a decrease in the transfer out to the capital facilities fund. So in summary for the general fund, the mid-year adjustments do result in a reduced general fund budget surplus from 2.2 million to 0.9 million. And the majority of that remaining surplus really is derived from mobile integrated health funding and dedicated to be spent on that program in future years. And I am happy to report that even with that reduction and these changes that we've talked about, our projected reserve balance at the end of the fiscal year, based on this recommended mid-year budget, would be 34 million, which would be approximately 15% of our net budgeted expenditures. So still putting us in compliance with our minimum reserve target. And that concludes my presentation. I'm happy to take any questions you have.
Are there questions?
Mr. Chair, this is Gay, and I think that one of our directors who's in the audience has a question about if there is a gross increase in overtime. I don't really understand the question, so I'm waiting for the other directors to see if she wants to follow up on that question.
Chair, this is Director Sailors, and I do have a question for Amanda, if I may.
Sure.
Amanda, on your overtime slide, there was a 4.6 million net increase in the overtime. Is there a gross number?
Yes, so for that account, and I'm going by memory, I believe the overall gross increase was about 4.5 million. And the reason why the net and the gross are so close to each other is because the reduction in deployment overtime, which is captured in the same account, is essentially offset by the increase in overtime that is attributable to there being position vacancies. So those are the two things that we try to adjust for when we're talking about the net number. And those two numbers happen to be very close to each other. I think one was 1.7 and the other was 1.6. So let me just confirm that number while I'm talking to you.
Thank you.
I believe if you look at that account, yes, it was a $4.5 million gross increase.
Thank you.
Other questions? Then Amanda, I'd just like to interject that I really appreciate the work as always. And the fact that we're going to maintain our 15% reserve levels is a great tribute to the efforts that you and all the team put in. So thank you for that.
Yes, and you're right, definitely a team effort. Like I said, identifying those non-salaries and benefits savings was really key to helping us get to where we needed to at the end of the day.
Well, it's greatly appreciated. With no further questions, then we will adjourn this meeting of the Finance and Audit Committee, and with our next anticipated meeting on 25 March 2021.
Thank you. And point of information, Melissa, shall we stay on this particular Zoom call to continue with our 6 p.m. meeting?
Yes, the regular meeting will begin on this same Zoom link at 6.
Thank you, ma'am. Thank you, Mr. Chair.
Thank you, Mr. Chair. Thank you, Amanda.
Thank you.
Thank you.